And now for the Money Rundown. Our Money Rundown segment is where we cover the recent news. There's a lot of media sources out there that are going to help give you updated information about the economy and the markets. Our job is to help you summarize, synthesize, and help pick out a few stories that are most important for you as a retiree or an investor. Joining us today is financial advisor Stephen Murphy. Welcome, Stephen.
Thanks, Scott. Story number 1, debt ceiling resolution. Earlier this month, the president and the Republicans reached a deal to avoid a U.S. default and resolve the debt ceiling risk. What are the biggest takeaways for investors, and are there still lingering risks?
Oh, man. Thanks, Stephen. I mean, this is a huge story for a month or two going up to the resolution, the debt ceiling, and really thankful that it got resolved. It was scary at the time, but like every time before, they fixed it and they've resolved it. The biggest takeaways are a few things. Number one, there isn't going to be any more debt ceiling debate until 2025. That's been deferred, the can's been kicked down the road. There was some small spending caps. There was a clawback of COVID funds, some work requirements for government benefits, some IRS cuts, and student loans are going to have to be repaid. Those are the biggest takeaways from the bill. But the biggest takeaway today from investors now is when we look at the past debt ceiling issues, there was a lot of volatility around the stock market around that, and the volatility continued after there was resolution. And the biggest reason was the downgrade of U.S. debt. So the thing we're keeping our eye on is there was a story recently in Reuters about there being potential risk of U.S. downgrade still even after they kind of reached a resolution. So it's something to keep an eye on. Is there a potential downgrade in U.S. debt and how that could impact the market, how it could impact the economy, and how it could impact you as an investor?
Story number 2, Treasury Secretary Janet Yellen testified before Congress this week and said that the odds of recession have gone down, and the Fed is no longer expecting a recession in 2023.
I thought this was an interesting story because the odds of recession have been pretty significant for quite a while. But our technical models are showing that the technical indicators in this market, they've been improving. One of our longer term indicators went positive a couple months ago. One of our more intermediate indicators went positive a couple weeks ago. So the technical indicators have been consistently improving. I know, Stephen, you run a number of technical models as well, and things have been improving. So to hear from Treasury Secretary Yellen that they don't think a recession is going to happen this year, I think it's kind of aligned with what we're seeing from the technical side. But I think what's important to remember as an investor is often the stock market can rally in advance of the fundamentals improving. So the economy can get worse, and yet the market can improve. And sometimes it's hard for investors to remember.
Story number 3, Morgan Stanley's Mike Wilson warns about a renewed bear market. Mike Wilson stated earlier this month that economic pressures are still mounting and are likely to bust corporate earnings. He added that a Fed pause can reawaken the bear market. Wilson has maintained his bearish position despite the market having a strong start to the year and entering into a new bull market, which many define as 20% rally off of the lows. This commentary from Wilson came before the last FOMC meeting, where they did in fact pause rates as he did predict. The market did not react well, but a light pullback is very different than a whole new bear market.
Yeah, Mike Wilson, he was right all of last year. He was probably the most bearish of analysts on Wall Street at calling the decline of 2022. But this year, he hasn't been right. And he's acknowledged that, and he thinks he's been a little late to the game. And the market's had a good, strong rally. S&P up double digits, NASDAQ up big. Bonds have been pretty flat. So he's been pretty wrong this year, and yet he's stuck to the bullish thesis. I mean, he thinks that earnings are going to come in worse than expected, that the public's going to be surprised by it, and that the market's going to see a decline. So Mike Wilson maintains his bearish stance on the market, and he is one of the more bearish analysts on Wall Street.
Story number 4, earnings breadth improving. Jury and Timmer of Fidelity put out a chart showing improving earnings breadth of the S&P 500. So what does that mean? It's a measure of percentage of companies that are revising their earnings estimates positively. So 3 months ago, Only 27% of S&P 500 companies had rising earnings estimates for the following quarter. Now it's up to 47%. So it's not perfect, but it is a growing improvement, especially as inflation continues to decrease.
Thanks for that info, Stephen. Yeah, I mean, I think it is more fundamental reasons why this market is moving higher. Naysayers like Mike Wilson have been talking about earnings coming in, about earnings misses, and we just haven't seen that. We haven't seen that. I mean, we're not seeing the same level of growth in earnings that we've seen in prior years, but we're not seeing the level of fall off that you might expect with rates where they are now. So it makes you more bullish on the resilience of the market and the resilience of the economy, increases that likelihood of a potential soft landing despite the Fed raising rates. We just have seen more companies beating earnings expectations and more than we'd normally expect. And that view is in contrast to what Mike Wilson has been saying and gives some ammunition to the bulls in this market.
And story number 5, more bullish historical data. So Ryan Dietrich tweeted out on June 12th a statistic showing the previous 15 times that the S&P 500 reaches a new 52-week high after going 1 year or more without one. 15 of the 15 times, a year later, the market was up and up more than 17% on average. So quite a good 12-month run after that. And we just hit that new 52-week high on June 12th after going more than a year without one.
I saw that tweet from Ryan and I thought it was compelling. I mean, the market's had a great start to the year. And historically, there's more and more data that's lining up that makes you more optimistic about the market moving forward from here. The market could continue to add to gains. Doesn't mean there can't be some volatility in the short term. And it definitely doesn't mean it all clear. When we look at the beginning of this year, analysts were pretty divided on if this market was going to go higher or lower, but really thought the market would be range bound. And the market has pushed to the top of that range, and people have had to revise their estimates on where the market is going from here. Why could it go higher? It could go higher because there's still a lot of cash on the sidelines, a lot of liquidity. It could go lower if the Fed has to keep raising interest rates to slow inflation. We saw that here this last week in the UK. They raised interest rates as inflation. They haven't been able to get a handle on it. So that's something that we could continue to see volatility on. But there's no question there's more and more technical data backing up the fact that we likely are not retesting the lows of last year, and we could potentially see new highs. And for us, it's one of the reasons why we've been pivoting more and more to make sure we're getting exposure to that upside if the market does recover. And for people that are still cautious about the market, there may be some strategies that you can employ to get some upside potential while still mitigating risk. And for us, buffered ETF strategies have been effective for people that are cautiously wanting to get back in the market, get some exposure, but still have some volatility risk and some risk management. And that's our money rundown for the week.